What's up guys, it's the Cheapster here, back with another video, and if you can't tell, I'm not feeling great today. It's because I'm actually just getting over COVID. You might have seen my community post. Yeah, I finally got COVID after 2 years of not having it. Finally got me, but I am about a week out, finally starting to feel better. But we are going to talk today about the IRS changing the standard mileage rate, because this is really important for you guys as delivery drivers or any kind of business owner, any kind of side hustle you're doing. You're probably using the standard mileage rate. It's very rare that you're going to be using the actual expense rate for your car. Usually you're going to be using the standard mileage deduction, so you just count your mileage and add that up. So we're going to go over what this means, what this change means for everyone as self-employed, delivery drivers, whatever you do. So here we go. Here's what the IRS says. This happened on June 9th. The Internal Revenue Service today announced an increase in the optional standard mileage rate for the final 6 months of 2022. Taxpayers may use the optional standard mileage rate to calculate the deductible costs of operating an automobile for business and certain other purposes. For the final 6 months of 2022, the standard mileage rate for business travel will be 62.5 cents per mile, up 4 cents from the effective start of the year. So I did kind of want to break this down, talk about what this means. So you can see the beginning of the year, it was 58.5 cents per mile. That's what we were getting as a deduction, and now it is going to be 62.5 cents, and that started July 1st, so that is past now, and now everything from July 1st is going to be the 62.5 cents per mile. I'm not sure exactly how that's going to work out in taxes, if that's going to be kind of confusing to decide which ones it was, if it was 58.5 or 62.5, but hopefully you keep good numbers on the mileage that you drive so that you can see when that split is, when this rate actually changed. But this is going to be through the end of the year, 62.5, and I'm assuming it's just through the end of the year because then they do new rates anyway for the new year. But so I kind of wanted to talk about how much this is, this 4 cents. Is this a good thing? Obviously, it's going to be a good thing because it's extra deduction for everybody. But I do kind of want to break it down and see, is 4 cents really worth all that, or if it should be a lot more than that? I'll give you a spoiler. It really should be a lot more than that, but let's go ahead and get into the numbers here. So beginning on January 1st, 2021, the standard mileage rate for the use of a car, also vans, pickups, and panel trucks, will be 56 cents. So that's what it was for last year. For 2021, this was the beginning of the year. It was 56 cents per mile. So we started this year at 58.5. So we had a 2.5% increase in the standard mileage rate from 2021 to 2022 in the first place. But what we've got this year, though, is just runaway gas prices. So this is a chart of where the gas prices have been over the years. So you can see the red is now, this is 2022, so this has just boomed and exploded. We started the beginning of this year under $3.50, which is crazy to even remember that, because yeah, I've been seeing more up towards like $5 and stuff like that. But I like this chart because it actually shows you too, 2021, we can see that 2021 we started under $2.50, which is pretty crazy. So we did have about a dollar jump between 2021 to the beginning of 2022. Which is pretty crazy, because you can see how these other years were, they pretty much started out around the same. So that's a big jump. But we can see in 2021 how that really went, and then where we started here in 2022. So the thing I wanted to look at was, they've changed this in the middle of the year. So how much has things increased from the middle of the year to the point that now they're saying they need to add another 4 cents to it? So they started at, let's say, around $3.50 here. Now actually the gas prices have come down a little bit. So today the national average is $4.63. So we went from, what is that? We could call that like $3.50. We'll just call it $3.50 just for sake, because it's not going to matter, because it's a tough argument to make anyway that they've raised the prices enough. So we say $3.50, and now the middle of the year where they've raised it an extra 4 cents, we are now up to $4.63. So we can go ahead and figure that out if we just take the $4.63 and subtract what it was, which was around $3.50. We're just going to call it that, which gives us 1.13. So if we divide that by the old price, which was $3.50, that should give us the difference now that we're at. So we've gone up almost a third in price from the beginning of the year just to the middle of the year, which is insane. I mean, I knew that we were kind of feeling these numbers as time was going on. I knew it was kind of getting more expensive, but to actually do the math on that and realize that the prices have gone up like that, and that's even with today's prices, not the prices that it was, where it was almost $5 a gallon national average. Now we're down to, like I said, 4.63. So it's pretty crazy to see that we've gone up an entire third in price since the beginning of the year. So I kind of wanted to see, okay, what does that mean then? If we've gone up a third in price, is that really worth it? Well, basically no, because we've gone up 4 cents, and the old price was 58, right? 58.5. So if we've gone up 4 cents, we've gone up, maybe around 6% or so or something with the standard mileage rate, and we've gone up 33% in gas prices. So this does not add up at all with what the standard mileage rate has gone up, with how much gas prices have gone up, which is not surprising. But to top all that off too, so it's already not following well enough with the gas prices and what it should be following with where we are now in the middle of the year. But to top that all off, don't forget, the standard mileage rate for business use is based on an annual study of the fixed and variable cost of operating an automobile. So what does that mean? It means it's not just gas, actually, too. That's the thing. You think of standard mileage rate, you think of it as, oh, it helps, like, deduct what your gas costs would be and stuff for taxes. But it's not just supposed to be your gas costs. It's also supposed to be for repairs, for just operating the vehicle in general, for anything that you have with that car, the insurance, all that kind of stuff. It's supposed to kind of like be a all-encompassing number to just give you an easy flat number to figure out what deduction you get to take on using that vehicle for business use. So that means it's not just gas. We are not even close to hitting what the rate increase should have been to account for how gas prices have been in tax deduction. And of course, because it's not just gas, this number right here comes into play a lot. So this was just released today. This is the inflation rate for June of 2022, which was 9.1%, which is insane. It's crazy that the rate just keeps going up too. Like, they keep raising rates to try to bring down the inflation rate, and it is just going up. So, but what this number means is that's making everything more expensive. So from the actual buying cars, used cars have been shooting up in price, whether you're doing repairs and stuff like that. Those prices have gone up because employees have, their wages have gone up too. Everything's just going up with it. So it means that the standard rate should go up, because not only are we seeing gas prices go up too, but we're seeing just everything that is involved in owning a car and using it for your business go up. So it's getting pretty rough out there with being able to use your car as a delivery driver, any kind of business, because you're just really, as the standard mileage deduction now is getting weaker and weaker. And it kind of used to be where you could game the system a little bit. I remember back when gas was like $1, or even around like $1.50 or something. That standard mileage deduction, if you had a pretty cheap car like a Honda Civic like I have or something, you could kind of game the system, and you could really like get pretty good standard mileage deduction, maybe more than what your car was even costing you, and that was awesome. Those days are over now. When I drive a Honda Civic, a cheap car, I still feel like I am just getting screwed by the standard mileage deduction. So if you're driving an expensive car, this is just a really tough time to use standard mileage deduction. And I think the actual expense deduction on your car is kind of impossible for anyone that's working like side hustle stuff, because I think you need to use the car fully for those businesses and stuff. So pretty much impossible for us to do. We're kind of stuck to the standard mileage deduction. And this is just a bad time for that. When gas prices go up this much, and when everything else goes up this much, it's not following in line with those price increases, and the government gets more tax money from you because of that. So I mean, they're probably very motivated to raise those rates and stop getting all that tax money from you. But I did want to show one more thing too on top of this. So this is my delivery cost estimator that is free. I'll link this below, that you guys can use to help figure out, like, when you're taking jobs on DoorDash, Grubhub, anything like that, what is good to take and what's not. But what you can also use this for right now is to see kind of where prices have gone and how much the mileage deduction should be, how much driving for your business is actually costing you. So we can put in today that it's 4.63. Is that right? Yeah, 4.63. That's what the average rate is. My car gets about 27 city mile per gallon. Current car value, 15,000. I think mine's now under that because prices have come down on the valuations a little bit, but other cars have not. So I'm going to keep it there because I think 15,000 is actually probably like a pretty standard rate for most people's used cars today. If you have even just like an older used car, they're expensive right now. Everything to buy is just very expensive. And then if you say your insurance is maybe $100 a month on your car, that might be a little expensive, but when you have to have business insurance, it gets a little more expensive like that. And then miscellaneous, I put $50 in a month because that's like repairs, stuff like that. And then your average work miles, I just put in 1,000 because it's just kind of simple, and that's 12,000 miles a year, which seems pretty moderate. You may do more than that, you may do less, but this breaks it down here. So this shows you here what your actual expenses are. So for me, this is kind of what I would be seeing. My actual expenses per mile are 48 cents. So the good news is that is still underneath what the deduction is. So technically I still should be like getting a better deduction even with the rates and all this stuff going crazy and stuff like that. But what you will notice is if you drive less. So right now I'm not driving 1,000 miles a month. I'm probably driving more like 500 or something, and that's where it really gets expensive, because then your extra insurance and all the other extra costs that come up every month and stuff, that stuff really starts to add up more and make this driving more expensive. So that then goes up to 63 cents, which is a little bit higher than what the standard rate is. And you know, that seems like, okay, well, good, that's kind of in line with what it should be. But again, I'm driving a Honda Civic. I'm driving a car that's like pretty cheap and stuff. And I'm probably not even accounting for everything in this chart that you would actually spend on your car. So overall, it's not great. It's not looking great. It's definitely expensive to be driving right now, and that you're not getting the tax deduction that you used to get. And I used to argue that doing these delivery driving jobs, at least you got a pretty good tax deduction because the standard mileage deduction was so great with how low everything else was, and that you could kind of game the system like that. Can't really do that anymore. So now you're kind of paying a lot of tax, and because you have to pay self-employed tax on top of all this, now the tax rate for doing self-employed work or doing like DoorDash and stuff like that is kind of getting more expensive than just working a normal job, because you really don't have that tax savings you used to have and stuff with this standard mileage deduction, because your expenses now are so high. So that's kind of what I wanted to say, kind of what I wanted to leave you guys with, to go over what this was. It might be a little bit confusing. Basically, you just need to know that the rate now is going to be 62.5 cents through the end of the year, and then they'll probably adjust that the beginning of next year. Who knows where gas prices are going to be then. I can't believe that we've gone up, you know, around 33%, a whole third up from the beginning of the year. So hopefully this gives you guys some insights on what this all means, what this means with the new rates, if it's a good thing, and what you can kind of do from here. But thank you guys so much for watching. Sorry if I've been sick. Sorry if my throat's a little croaky right now. It's hard for me to talk too well. But if you guys like the video, remember to do the cheapest thing you can today. Tap that like button. Also subscribe to the channel for more updates and stuff like this. And I will see you guys in the next one. And remember, stay cheap, because the IRS is not going to stay cheap for you.
Hey, you better be saving that money. Don't you be spending it now. You're still here watching this? You might as well just subscribe. Why would you not at this point?